Hey there, everyone. My name is Ryan Schul. Welcome back to my channel. This is all about data science, machine learning, deep learning, and things of this nature. So today my camera's not working. I'm not sure what happened, but try to figure that out and get that thing resolved. In today's project, I want to talk about how to make smart investments when the trade tariffs become effective, right? And how to position yourself for the impending doom that we will probably face imminently unless some miracle occurs and things change. But yeah, let's see. I put together some scripts here I want to take you through. We're going to pull in some data from Yahoo Finance, do some basic returns, and then try to pick some investments that should perform reasonably well because these are going to be good hedges against high tariffs coming into the United States and other countries too, right? So first of all, what is a trade tariff? It's basically a tax that's imposed by the government on imported goods, also known as a custom duty. Okay, so it's a form of trade regulation. It's used to influence international trade and often protects domestic industries and generates revenue for the government. The downside is it gets very expensive for consumers to purchase products, right? Um, I'll see if I can do the video without saying his name, but a certain somebody wants to increase tariffs by anywhere from, I guess, 100% to 150%. I mean, I just barely watch the news. I try not to watch the news too much these days. I feel almost like ignorance is bliss, but the last thing I heard was about 100 to 150%. So that means that the things that you buy at the local store could become 100% more expensive or 150% more expensive for whatever it is. Okay, so we'll see and how things work out. Nobody really knows. There's a lot of confusion, ambiguity, a lot of bewilderment. You can call it whatever you want, but there's definitely some uncertainty in the market. But not every company is going to be impacted the same, right? I think some companies are actually going to profit and probably profit quite hugely when these trade tariffs are implemented. Okay, and I've got some notes over here. You can read through this. I'm not going to take you through all the details here, but there's just some more information about trade tariffs. So I just want to get into the point here. So we can go ahead and import historical time series data from Yahoo Finance. I use this in a lot of my videos. If you saw our other videos, you're probably familiar with this at this point. And I'm looking at a couple companies specifically here. So these are domestic manufacturing and steel companies. So I think these should perform quite well when these trade tariffs are implemented, right? Another sector or industry, whatever you want to call it, should be energy and natural resources in the United States. So these companies, I think, are going to perform quite well. Our agriculture and food, I think these companies are also going to be winners in this trade tariff battle. Defense and aerospace, so these are good contenders for investment. Semiconductors, okay, anything that is made domestically and they don't rely on a lot of imports from other countries, these stocks should perform reasonably well. There's a few more I've listed down here. Okay, so you can see this mass, mum, Dove, VMR, so on and so forth, UPS. And then I'm looking at a few ETF symbols. So I like these ETFs because you get instant diversification and professional money management, right? So an ETF is a little bit like a mutual fund. A mutual fund you can trade at the end of the day. You get I think it's called the NAV, net asset value, and you would buy in at that price. The ETF is somewhat similar, but you can trade it throughout the day, so you don't have to wait for the daily closing price, right? You can buy it whenever you want. I found this website a while back. I like this a lot. This is called ETFDB.com. It's for ETF database. That's what's called over here. And they have very good coverage of, I think, like 3,700 ETFs. And there's all kinds of different analyses you can do over here in terms of performance, in terms of like the cost of the fund. There's always going to be a small charge, right? Because you have professionals managing these funds and you have to pay them their salaries, right? So it's not like investing in a specific stock, but again, you have professional managers running the show and you have instant diversification. So you're not investing in one specific company, you're investing in a bunch all at once. Okay, so let me just take a look at this one right here, BABX. I'm not even sure what this is, Granite something. Um, so you have dividend evaluation, you have expenses over here, so you have some details about the fund. And I was just trying to look at the holdings. Oh, here we go. Holdings. Okay, so you can see here, 100% US dollar. Okay, so I'm sorry, I was trying to point out like how diversified these things are, and this one is not at all. Let me pick another one. The point I'm trying to make is that there are a bunch of investments usually underneath any of these. So here's Nugget. So this is gold, right? Let me see, holdings. And again, okay, so just and two. So VanEck and US dollar, and there's the percentage of assets. That's a little bit unusual. A lot of times you'll have like several different companies or several different types of investment asset classes or whatever. So you do get some diversification and just pick two that happen to be not very diversified at all. But anyways, I think this is pretty decent resource, and I did see some very interesting things over here. If you get to this page, you have to poke around a little bit when you get here. Oh, there it is, 3,770 ETFs. So very good coverage, right? It's probably the most out there. I don't think I've seen more than this. I like this tab. It has returns, and then you could sort this in different orders. So you can see the year-to-date return. This microsector gold miner year-to-date up 163%. This 1 month return is up 40%, and the 1 week return, actually for the same, is up 70% in 1 week. So that's pretty phenomenal performance. Like if you put in $1 million, you would have made $700,000 in 1 week. That's big money, guys. It's big money. So so that's it. You can take a look at this. I like this for ETFs. Let's get back to the project over here. So yeah, you pull in all this information from Yahoo Finance. I will go ahead and hit Control Enter on my cell to run it, and you can see the results down here. I'm getting the start and end date 12 months back from today. Okay, so it's calculating dynamically. I think this is a good duration for this type of analysis. You can pick 3 months, 6, 12, couple of years, whatever really suits your purpose or whatever fulfills your need. I think 12 is a good place to get started with this. So I'm pulling in the historical data, and I'm getting 41 tickers. I'm calculating returns in each one. Okay, so just a quick sanity check just to make sure all my symbols are coming in. There's no errors. There's no mistakes here. And this looks pretty good. I'm going to go ahead and calculate cumulative returns because I want to see just overall how these stocks are performing. Okay, I'm going to assign one of two colors. If the return is positive, I'm going to make it green. Okay, if the return is greater than 0, otherwise red. So I have my greens and I have my reds. This is a plotly chart. I like these a lot because you can zoom in, you can see all the details here. Okay, and you can put the mouse over, and I think it's called a tooltip or bubble, whatever, it pops up, and then you can see the percent return. So I'm looking at 40.15, 47, and the highest is 69.97. Remember, this is 12 months back, and these are the combinations of ETFs that we pick and individual stocks. So you can see for the past year, some of these are down quite a bit. Over here, if we go to the right, so these are really the big losers, down 53%, 44, 41, and 40. So the point is, last 12 months, basically, a few of these stocks, about 1/3 were performing decent, and about 2/3 were not performing very well at all. I think this is going to change. I think it's going to turn around, and I think we're going to see a lot more positives in the very near future here. And the reason I say that is because we experienced a small trade war back in March of 2018, where U.S. government announced tariffs on steel and aluminum imports, promoting retaliatory measures from China. So we have a point in time that we can analyze where these tariffs went into place, and we can see what the impact was back then. Now, this time it's a little bit different, right? I think the tariffs are going to be much more aggressive this time, and the market is a very dynamic place. It can be very fickle. It can be very finicky. You've seen a lot of volatility in the stock market in the past couple of weeks since all these trade tariffs were first announced about 2 weeks ago. It's now actually tax day. It's April 15th today, so The news came out a couple of weeks ago, but we can make some assumptions about what happened in March of 2018 and see what the result was back then. So I'm going to go ahead and import the data. This time the dates are not dynamic, right? So I'm not going back 12 months in time. I'm picking a very specific start date and very specific end date. So this is about 3 months before and about 3 months after the tariffs in 2018 were implemented. Okay, so we can see what the actual result was. We have cumulative return before shock, and I'm calling the trade tariff the March 2018 was a shock period. When you shock the market, you just add a stimulus or um, some type of pretty large event, right, that has an impact on the market. That's what we're doing here. So we have cumulative returns before shock and after shock. Okay, so here's my returns. I'm going to go ahead and plot these just like I did last time, and we can see last time, now we have mostly green, more than half are green. We still definitely have some reds over here. I can put the mouse over, but not too bad. I mean, hopefully people weren't invested in this PPC. That one's down 21%. This was the next biggest loser, 13%. But now you see about 2/3 of these stocks are actually green, right? So they're actually all winners over here. And inevitably, you probably will pick a couple of losers. Hopefully your portfolio isn't mostly these stocks on the right-hand side. But like I said before, if you diversify, like an ETF would do for you naturally, or if you pick a bunch of stocks yourself and diversify, you should be in a good position um, to make some money here, right? But of course, nobody can predict into the future what a stock is going to do, right? Could be get up, down, sideways. Nobody knows. Nobody knows. So this is cumulative returns after the shock. This is cumulative returns before the shock. Okay, so you see that there was some impact, actually not huge. Okay, but again, back in March of 2018, things weren't quite as dramatic as they are right now. I feel like that was a little bit more subdued, a little bit more, um, I don't know, just tempered or restricted or something. Now it's like everything is just completely wild. So I think the impact is going to be bigger, and I think you'll see a lot more greens. And of course, it's probably going to be some reds. I don't think every single stock in this list over here that I put together is going to perform well. I don't see that happening. But again, if you diversify and pick stocks that should be resistant to these trade tariffs or benefit from these trade tariffs, I think that's a good strategy. I think that's a very good plan right now. So let's go down. So here's the cumulative returns before and after the shock, right? And we can create some investment buckets and look for good candidates to go long and potential short positions too. So short position is when you sell the stock and then buy it in a future date at a lower price. So you expect the stock price to depreciate. You buy it or you sell it today, buy it back cheaper, and you keep the difference, right? So these are good candidates for going long and for going short based on the cumulative returns we saw above. Okay, just look at this list. Okay, it's basically the top performing stocks from this list, and then the bottom performing stocks for the shorts. That's all that is. Okay, and we can actually measure the Sharpe ratio. So the Sharpe ratio is a risk-adjusted return. So all of these stocks, you have to look at the volatility of the stock. That is going to be the standard deviation of the price movement. I have some videos on how this works. So you would take the return minus the risk-free rate, divide by the volatility, or the standard deviation rather, of that stock, and get the Sharpe ratio. So this is a very important financial metric for understanding how well the stock is performing after adjusting for risk. So if you have a lot of risk in stock and it's up a little bit, it's really like a bad position to be in, right? Like you want less volatility and more return. If you have just small return and lots of volatility, that is not a good performing stock, right? So you really have to look at the Sharpe ratio to really understand how these things are performing, right? So I have the Sharpe ratios calculated here, and then I'm ranking everything based on the Sharpe ratio. So, okay, so 14 is going to be the highest Sharpe, or 0.14, this is 0.12, this is the risk-adjusted return, 0.11, so I'm ranking these in descending order down to the bottom PPC. We saw that over here. So the top was LNG and PPC was the worst, right? If we go back here, PPC is the worst. I think it actually gets it from this chart. after the shock. Okay, so there's LNG, that's the top performing stock, the risk adjusted return. You can see the return is actually 28, and this is negative 21. If we go down here, the Sharpe is going to be similar but slightly different because we're adjusting for the riskiness of it. So now it's 14, it's not 28 anymore, it's actually cut in half. Okay, that stock is pretty risky, and this is actually worse because it's 23, right? So here is the average Sharpe by sector, okay, calculated by the sector. So another good idea is to invest in a sector such as tech, materials, or industrials, not necessarily investing in specific companies, right? So you have the diversification instantly from a few different companies where you're making this investment. You're not putting everything into one specific stock. You're putting it into a sector or an industry that should perform pretty well. So it's tech, materials, and industrials should perform pretty well. And again, we're looking at the Sharpe ratio by sector. And then I have one more chart down here. We have, let me refresh it, top tickers per sector. And it's producing the chart. Now what happened here? Oh, I think I didn't refresh this. Okay, let me refresh this one. You have to do these things in order, or Python starts complaining. Now what's wrong? Group by sector. Is sector gone or something? It says group by sector. I'm gonna have to look into this one because this literally just worked yesterday. Sometimes I play around with the code and it accidentally fat finger key and delete something or who knows what. But let me look into this. I promise I'll fix this up before I send out the code, and I will share all the code samples with you guys so you can explore and experiment and do your own analysis, right? It's very, very easy to do this. All you have to change is over here, your inputs are going to be the symbols that you pick. Again, I think look for something that is in domestic manufacturing, look for energy, natural resources, agriculture, defense, aerospace, semiconductors, and there's a few more listed over here. So play around with it. Go ahead and update the symbols to be whatever you want, and you can change this date right here to be anything. 6 months, 3 months, a couple of years, 10 years. You can go back 10 years in time, but you want to make the analysis relevant to the duration of time that you are expecting there to be an impact, right? So with trade tariffs, I don't think you would go back 10 years. That doesn't make a whole lot of sense, but at least several months. I think in this case, 12 months makes sense to me. Maybe to somebody else, you would go back a couple of years, but I think 12 is a good place to start. Change the stock tickers to be whatever you want. And you can take a look at this ETF database and get some ideas over here. And then there's all kinds of asset classes. You can pick whatever you want and get some ideas from that as well. So that's it, guys. That's how to make smart investments when the trade tariffs become effective. Hopefully this was informative and enlightening, and hopefully good use of everybody's time. I will fix that code issue at the end, and then I'll post the code with the video later today. Thanks, guys, and catch you in the next one. Bye.